Thanks very much for the introduction. I think the topic is quite an interesting one, and how it's positioned as the unlisted investments, the ideal situation. I think having worked in this part of the market, in the unlisted part of the market for the past 13 years, I know that the real situation is not always the ideal one. And I would say that over that time, there's been quite a lot of evolution in the way that unlisted investments are done, and the way that the control environments and the processes and even things like valuation and administration, all of those things have been evolving areas over time. And positioning this as the ideal situation, it kind of allows us both to look at global best practice and things that happen in different parts of the world, but also look to see how these types of investments are being done in a practical way in smaller markets in particular. So that's really the context for today, and we're going to start with just first of all just looking at the global position and how retirement funds are actually incorporating alternatives in general, and then the unlisted components of that in particular. So if you look at what this chart is showing us, it's that most of the large pension fund markets, these are called the P7, the largest pension fund markets in the world. They're all incorporating significant allocations to alternatives. You see that we've got an average of over 25%. So the numbers here, what's shown as alternatives includes what we would consider to be private equity, but also things like hedge funds, unlisted property, private credit, and all of those sorts of alternative types of investments. So outside of the listed equity, listed bonds, and cash, this is kind of the rest. And how this exactly gets done in practice definitely varies by market and by by individual pension funds. But I think what you can take from this is that there are significant allocations. This is a part of the portfolio that's taken extremely seriously in all of the large retirement fund markets, and billions of dollars globally are allocated every single year to new investments in the alternative sector. So even for those of us working outside of these the P7 markets, this at least tells us that the largest markets in the world are taking this area seriously. They think this is something that should be incorporated into their portfolios, and that should at least make us give us pause to think, how do we kind of incorporate some of that into our own portfolios? How much should we take into account? What's practical? What should we be doing locally versus what should we be doing globally? It should be part of our thinking. And clearly, in Namibian regulation, this is definitely part of the thinking for retirement funds. And I think some of the difficulties have been practical ones. And I think we're going to talk to some of those items a little bit later. So firstly, why are these large global markets looking so much at private markets? What are the kind of the broad areas that make it attractive and that make this such a significant part of these portfolios? So firstly, it's around returns, and that's how in investment markets, returns are always top of the list. So the returns that have come from private markets investments have been very strong in recent years and have led to a huge growth in this area. But not, when we're thinking about returns, we can't just think of the gross numbers. We've got to think about, when we're thinking about allocations between, say, listed equity and private equity, we've got to think, how do we actually generate alpha and proper diversification? So how do we get better portfolio attributes from the way that we do These are kind of the aggregated returns of funds that have been started in any particular year. So, for example, these funds that were started in 2001 have shown very strong returns. Funds that were started just ahead of the financial crisis and did their investing just ahead of the financial crisis have been on the more muted side. So what we can take from this is overall, through the cycles, the global private equity returns have averaged around 15%. But what we can also say is that it's been much better to invest kind of in the wake of a crisis than it has been to invest, at the top of the cycle, which is what we know from any kind of investing. So investing ahead of the financial crisis, meant that some deals were probably overpriced. Investing in the wake of the dot-com bust was a great time to invest. And those rules apply across asset classes, and they still apply in the private equity space. But what is quite interesting to see is that even no matter when investments were done, you don't have in aggregate, you don't have any periods which experience capital loss on a net basis. And if you invested through the cycle, receiving a dollar return of 15% per annum over these long periods of time is a great result. That's not to say that it'll be exactly like that going forward, but this is a relatively long period where we can say, you haven't experienced capital loss, and there have been some, areas of very high returns. So I think that's enough to make it at least interesting to look at. If we think more locally for a minute, if we think about how the results of the savings that happen in any particular economy. So if individuals are pouring part of their savings into their retirement funds, and the bulk of the savings pool in a particular country is in the form of retirement funds, then what those retirement funds do with the asset allocation, where they decide to actually put their money, is extremely important for the way that the capital markets develop in those countries. And this is kind of sometimes an interesting tension, because the responsibilities of retirement funds are to invest for the well-being of their members, and for the financial outcomes of their investors. But at the same time, there must be a recognition that the way that investments are done also has that impact on what happens in the local economy. So whereas if retirement funds in a particular country only invested in, say, listed instruments, you would land up with the position where there's good capital access for large firms and good capital access for governments. But you might land up in a position where there's not a whole lot of capital available, equity funding in particular for local firms. Maybe they can, maybe there's banking products that they can get, access to loans is fine, but access to risk capital, equity capital, might be difficult to come by, which inhibits growth. And similarly, on the infrastructure side, we all know, I mean, in every country there's a lot of discussion around infrastructure, and Namibia is no exception. And the bills around infrastructure development are simply too high for governments. And so if we truly want infrastructure development in all of our economies, we need to be thinking, where does that capital come from, and how can it be done in a way that works for retirement funds, and also works for the local economy, and works within the structures that are available within the country. So we would say that these two last blocks really form the real economy funding in any particular country, and they're quite important. I think they're increasingly being recognized as important components of something that's sometimes not that well understood is how important the selection aspect of choosing funds is in private markets. And I kind of have another version of this chart where we kind of start with, the dispersion of returns in, for example, in bond mandates versus equity mandates versus, kind of moving down the spectrum all the way through private equity and ultimately into venture capital. And, what you see from that is that the further you go along that continuum, you get more and more into, you get a much higher dispersion of return as you go along. So in a listed bond mandate, you get a very tight grouping down this continuum. The more important manager skill becomes, and the more important the manager access to deals becomes. And there's been a lot of research done in listed markets that talk to the fact that you don't get a lot of replication of first quartile managers from period to period. But in the private market space, it's actually quite different. And you get a much higher consistency of the best managers actually producing the best results consistently. And there's some good reasons for that. In the extreme example of venture capital, you land up with a situation where the potential portfolio companies for venture capital investments, they only want to work with the best venture capital funds. And so they actually seek out the best business prospects, the best investment prospects for venture capital funds actually seek out the best venture capital investors. And likewise, and that gives the best, the most recognized best venture capital investors the ability to choose more and perhaps even get better pricing around their investments. So it's almost a self-fulfilling prophecy. And that happens to some extent in through the private equity space as well. So you normally have, this is a generalization, but you have around 15% dispersion of returns between if you're getting invested in the top performing funds versus say the third quartile funds. So this is an extremely important aspect of actually working, of investing in the space. It's not a matter of just choosing what's out there and we'll get asset class exposure. It's actually, it's much more important than that. Really the last slide I have here before I sum up, but there's a fair amount to talk to here, is around all of the control structures when you're investing into private market funds. And I'll start with the fund governing documents. So, and all of these elements add to the control environment. They're all important. They all give an investor into a private market fund some degree of reliance over what's happening in the funds. I wouldn't say it doesn't give them. None of these elements give an investor into a private market fund control over investment decision making. These are all elements where the investors into these funds can actually exert some control over the governance environment and the way that things get done. So it's all about that. It's about saying if we're going to invest in one of these funds, we need to understand the environment. We need to have proper controls in place. We need to get the reporting out that we need, and we need to understand the impact. And then where you get issues like conflicts of interest or other types of issues that come up that need investors to weigh in from a governance perspective, we need mechanisms for that to happen. So all of this starts with the fund governing documents. So typically, in most parts of the world, these funds are structured as partnerships, but some are structured as trusts, and some are structured as companies. But no matter how they're structured, the fund governing documents tend to have similar elements to them. They define things like what exactly the investment mandate is, how the management fees work, how all of the fees work, the ability to invest and reinvest capital, and then onto things like how does a fund manager get dismissed? If the investors are no longer happy for whatever reason, how do they actually fire the fund manager? You have different clauses for whether the fund manager has done something wrong or whether the investors simply no longer trust the fund manager for whatever reason. So you have different mechanisms for all those things. You have all of the terms around how liabilities are managed, the ability to reclaim capital from investors. All of those sorts of things are encapsulated within these fund agreements. In addition to those governing documents, you have side letters, and the advisory committee is there. That's somehow equivalent to a board of directors. It's not equivalent to that. The advisory committee does not have any responsibility for the investments of the fund or most of the running of the fund. It has specific areas of responsibility that are actually set out in the fund governing documents, and then where more detail is needed around that, there's sometimes an advisory committee charter which actually sets out the areas that an advisory committee is responsible for. So the advisory committee is made up of the investors' representatives. So if you've got 5 pension funds invested into a private equity fund, maybe not all of those would form part of the advisory committee, but at least the largest investors would actually make up the advisory committee. And then if there's things like conflicts of interest that arise in the fund, then that kind of decision would be referred to the advisory committee. The fund manager would have to present what's happening with conflict and how they've mitigated it, and then that would come for approval. So through the fund governing documents, there would be a number of items that actually are set out specifically for advisory committee approval in those particular instances. Another very, very important control mechanism that we look for is independent investment committee members. What you have had in the past in some private equity firms is that the investment committee is simply internal. What that actually means is that in practice is that it creates an environment where corners can be cut. Whereas if you have independent members of the investment committees, you have their own reputations at stake around the investments that are done and the way that and the processes that are followed. They have, your internal team has some accountability to independence, but without having to come to the investors for that. It gives a separate reference point for appropriately qualified but independent people to actually need to be convinced before an investment happens within a fund. Independent administration is also an extremely important part, and I know this is a slightly contentious issue in the Namibian context. But as in 2074 in our own investments, we no longer invest in funds. We have invested in some in the past, but we no longer invest in any funds that don't have independent administration. We've seen it as such an important control factor, and we've seen blurring of lines in the past where you don't have that, where you have an internal administration team. You are courting some problems, even when there's no ill intent. There's things that happen along the line that can lead to a breakdown in the control environment. What's also important is to have the annual audits and scrip counts, so to make sure that the investments that the fund says they hold are actually held in the way that they say they hold them in the right amounts. That can form part of the broader audit. In South Africa, this is a 6-monthly scrip count is also required as part of the regulations around pension funds investing into private equity funds. So those kind of give you also an independent check that what the fund manager says is in place is actually in place. Also very important is the financial alignment between the investor and the fund managers. You would look, the key kind of terms around alignment are, you don't want excessive fees. You want fees to cover the costs cover legitimate costs of running the operation, and you don't want to actually tighten that too much. You want that, you want the fund manager to have sufficient fees to actually pay for the running of the manager in order to allow them to manage the fund. But you also want them to have some of their own capital at stake, and then you want them to be linked to the upside as well. You do want them to have, to be incentivized by the performance of the fund, both on the upside and the downside. Quarterly reporting, there's very good international standards around quarterly reporting, reporting around each of the investments, around the performance of the fund as a whole. And that allows you as the investor to monitor well. When you combine, for example, the quarterly reporting and monitoring function. Private markets are attractive, and they're attractive globally because a return premium can be earned, and different sources of return are on offer, so you can get that improved portfolio impact. So it's an important part of the investment universe for pension funds to look at. Globally, it's extremely established. I mean, it's become an absolutely enormous part of the global investment markets. A lot of that is, even though it's become so large, it's still tilted towards the US and the most developed markets. And we think it still has quite a long way to run through the more emerging markets and the rest of the world. So it's still an evolving space, but it's become a massively important part of global investment markets. And then finally, it's very important that these controls are in place. If you're going to see the benefits, if you're going to get the benefits of the return premium, and not have the failures along the way which really detract from return, then it's very important to put these kind of control processes in place and make sure they're in place in the funds that you invest in. Otherwise you do have a much higher chance of seeing failures of funds or issues with the way that the funds are operating. And also you'll have a much tougher time of actually monitoring the funds if you don't have these types of things in place. So that's all I've got for you from the presentation side. I know we're going to go into the panel discussion next. Thank you very much.